Wow, 2024 was something, let me tell you, for the entire GTA, but especially for the Toronto and Mississauga housing markets. From record low sales, which led to improving affordability and growing inventory, 2024 brought a big shift to the market. But what does this mean for you in 2025? Well, that's what we discuss as we break down the key stats and trends from the previous year and what I'm looking at in the year to come. My name is Morgan Little. I'm a realtor here in the GTA. If I can ever do anything to help in your real estate journey, feel free to reach out, book a call using the Calendly link below, or just simply shoot me a text and I'm happy to connect. Now, let's get into it. Starting with a statement from the Toronto Real Estate Board. Borrowing costs were top of mind for home buyers in 2024. High interest rates presented significant affordability hurdles and kept home sales well below the norm. The housing market did benefit from substantial Bank of Canada rate cuts in the second half of the year, including 2 large back-to-back reductions. All else being equal, further rate cuts in 2025 and home prices remaining below their historic peaks should result in improved market conditions over the next 12 months. Now let's get into the numbers. I'll take a look at the overall GTA stats and then I'll get into Mississauga because I know that's where a lot of you are looking. The total number of sales across the entire GTA in December were 3,359, which is down almost 2% from the same time last year. The number of new listings were 4,681, which is up a good 20% from last year, leaving 15,393 total active listings at the end of the year, which is up almost 50% from last year. Wow. And an average price across the GTA in December of $1,067,186. Not much of a change from December 2023, just a point and a half. The average days on market went up from 32 to 36, 12%, which makes a lot of sense since there's not a lot of sales happening, so homes are sitting longer, giving buyers more options. Now, breaking it down by property type in the city of Toronto to give you an idea, in the 416, the average price of a detached home was $1,624,500. So still holding strong in that segment of the market, where semi-detached homes were at 1.3 million. Townhomes, 900,500, and condo apartments, which has been the slowest segment of the market overall, still has an average price of $720,000. Now, moving on to Mississauga, as I know a lot of my viewers are looking for homes in that area, it being in the Peel region follows the broader trend of the GTA, but every market segment does tend to have its own uniqueness, so let's take a look. Across all home types in Mississauga, we're looking at a total number of sales of 288 in December, with an average price of $977,833. There were 421 new listings in December, leaving a total number of active listings of 425 moving into the new year. Breaking it down by property type, Mississauga detached homes had a total number of 97 sales in December and an average price of just under $1.4 million. So again, detached homes holding strong. There were 124 new listings, leaving 472 total listings at the end of the year. Moving on to semi-detached, we had 40 sales in December with an average price of basically just over $1 million, with 45 new listings, leaving a total of 102 active listings as we closed out 2024. Townhomes only had 12 sales in the month of December with an average price of $1 million. 13 new townhomes came on the market and left 35 active listings as we closed out the year. Now on to condo townhomes, there was 55 sales, so quite a bit more, but there are more condo townhomes than freehold townhomes, so that kind of makes sense. You have an average price of $771,785. 63 new listings for townhomes came onto the market, leaving a total of 209 as we closed out the year. Now looking at condo apartments, which took the biggest hit out of all market segments, we had 83 sales in December, with an average price of basically $600,000. 174 new listings came onto the market, so lots to choose from, leaving a total of 600 listings to choose from total moving into 2025. And so what effect did all this have on buyers? Well, like I mentioned, early on in the year, higher interest rates and economic uncertainty definitely dampened much of the market activity. But as rates began to decline, buyer confidence improved, leading to some increased market activity. Overall, though the market did end up somewhat favorable for buyers, hesitation inflation due to the economic uncertainty and the instability in the interest rate environment kept many people sidelined for much of the year. Now, will that change in 2025? Well, let's talk about the outlook for 2025 and 8 key factors that I think you should keep an eye on. Number 1 being interest rates, which have been a key driver in the market. I do believe interest rates will remain the most significant factor impacting the market in 2025. We've been seeing them come down, but will that continue? Taking a look at variable rates, which are tied to the Bank of Canada's overnight rate. Any decreases could make borrowing cheaper, stimulating buyer demand. However, rate cuts can also be a signal of economic challenges. And then you have fixed rates, which are tied to the 5-year government bond yield. These rates may continue to move independently of the variable rates. Fixed rates are the most popular option for Canadians, making them critical to keep an eye on. Now, what impact will rates have? Lower interest rates could improve affordability, while higher rates would suppress demand. The interplay between rates and inflation will be a determining factor on the housing market's trajectory. The forecasts from the country's big 6 banks are split on how much the Bank of Canada is likely to continue easing rates in the first quarter of 2025. BMO, Scotiabank, and TD anticipate just 1 quarter-point rate cut in either January or March, while RBC, CIBC, and National Bank expect a more significant 50 basis points of easing. The second factor will be mortgage renewals, which will be the real affordability test for Canadians. With thousands of Canadians set to renew their mortgages in 2025, the renewal process will test homeowners' financial stability. Most homeowners were stress tested at 5.25% or higher when they secured their original mortgage. While renewal rates may be higher than their initial terms, many will still fall below the stress test threshold. To lower monthly payments, banks may allow homeowners to extend their amortization periods back to 25 or even 30 years. While this reduces immediate financial pressure, it increases total interest paid over the long term. Third on my list are the new mortgage rules coming into effect, opening the door for more buyers. One of these being 30-year amortization for first-time homebuyers. This rule, applicable to those with less than 20% down, reduces monthly payments significantly, making home ownership more accessible. There's also the CMHC cap increase to $1.5 million. The increase from $1 million allows buyers in high-cost markets like Toronto and Vancouver to access insured mortgages with smaller down payments, potentially driving demand for pricier homes. These rules may bring more buyers into the market, but could also increase household debt levels. Number 4 is a big one, the federal election, currently scheduled for October 2025, but now that Trudeau has recently announced his resignation, there could be calls for an early election. This uncertainty could make buyers adopt a wait-and-see approach, delaying decisions until the election results provide more clarity. I recently did a video discussing Pierre Poilievre's housing and economic stance now that he is probably going to be our next prime minister. You can watch that here. Because a new government is likely to introduce new housing policies affecting affordability, taxation, or supply, adding an element of unpredictability to the market. The fifth factor to keep an eye on is the housing supply and what's being built. There's an urgent need for affordable, family-friendly housing rather than high-priced condos or investment-driven developments, as well as purpose-built rentals, which help renters, though they may limit opportunities for home ownership. A continued lack of affordable options could have the continued effect of pushing buyers towards less expensive or secondary markets. Speaking of the rental market, it looks like we're going to continue to see rising rents in secondary market with falling rents in some of the major cities. This is due to the shift that I talked about, where not only homeowners are being pushed out of major centers due to affordability, but also renters. Some of the biggest challenges have been the high development fees and taxes in 2024, which made new construction unfeasible for many developers, particularly in Toronto and Vancouver. If development remains slow in 2025, it could lead to continued supply shortages moving in the coming years. Lower rates and government incentives may help breathe some life back into the development community. Number 8 on my list is the overall sales volume and whether or not confidence is returning to the market. Sales in 2023 and 2024 were well below the 10-year average. This is reflective of buyer hesitancy among the uncertain economic environment and the rising interest rates we've seen. But lower rates, new mortgage rules, and improved affordability could bring more buyers into the market, increasing sales volume. However, confidence will largely depend on economic stability and buyer perceptions of many of the factors I just listed. But you're doing the right thing by staying informed of these new trends, whether you're buying, selling, or investing. I'm curious, what are your thoughts and biggest concerns about 2025, or do you think the future's bright? Let me know in the comments below, and again, if there's ever anything I can do to help in your journey, feel free to book a call using the link below. Simply shoot me a text with your thoughts, and I'm happy to have a chat. Till then, I'll see you on the next one.